Thank you so much. As I was just saying, I started off the summer visiting with...
You'll have to, there you go.
Well, I didn't learn how to manage the mic. But I was saying that I started off the summer by testifying, and I'm glad to be back to close the summer out by testifying. Very happy to be here. I think this topic is a really, really valuable topic for us to consider in West Virginia. I just like the idea of discussing the Earned Income Tax Credit or a potential state EITC for West Virginia. The topic's interesting. I mean, here we're talking about issues of fairness and justice with public policy, very important and challenging issues to wrestle with. We're talking about trying to find ways to boost workforce participation, especially among groups that face special challenges such as single mothers. We're talking about trying to promote income mobility, and we're talking about trying to ultimately make for a safety net system that enables people to get some cushion in the short run when unexpected challenges occur, but a safety net system that ultimately enables and encourages people to become self-sufficient in the long run. I think it's a really interesting question for all those reasons, especially the idea to think about how can we ensure that our system enables self-sufficiency over the long run while providing a cushion for short-run unexpected challenges or difficulties. Just a little bit of history, if you'll just humor me. I have a couple of slides here with kind of historical perspective on it. But one problem was with traditional welfare, I'm talking about years ago, traditional welfare brought with it a strong disincentive to enter the labor force. Traditional welfare wasn't given much thought. It was just, here's welfare to help support low-income people, but not much thought was paid to disincentives or work disincentives or adverse consequences that may come along with traditional welfare. So if you look under traditional welfare programs, strong disincentive to work, especially because there was effectively a 100% tax rate for people on welfare traditionally, because welfare benefits were reduced $1 for every dollar that someone earned as they started to try to become self-sufficient. So if you're facing a 100% tax rate, it's no surprise that we have this adverse consequences of encouraging people to stay on welfare rather than the opposite, rather than encouraging self-sufficiency. But this idea of a negative income tax goes back to a Nobel Prize winner, Milton Friedman, in a very influential work that he had in 1962. He was a fellow who really paid a lot of attention to adverse incentives that may be created by public policy, like that negative work disincentive that I mentioned. And he focuses on, he was talking about traditional welfare and that problem. He advocated this idea of changing our current system such that we get rid of traditional welfare, or at the very least reduce our reliance on traditional welfare, and instead we replace that with the negative income tax. So negative income tax, you're going to have a graduated rate structure for people who are earning, $20,000, $30,000, $40,000, $100,000, whatever. You'd have a graduated rate structure just like we have now. But at some point, whatever income threshold it may be, $15,000, $20,000, you're going to hit a 0% marginal tax rate. And then for very low income people below that threshold, you would have a negative income tax rate. So instead of paying taxes to the government actually gives you a wage subsidy for income that you earn below that key threshold. So negative tax rates, zero tax rate, and then a graduated income tax rate structure like we see now with the federal personal income tax and with our state income tax. But this negative income tax, it's effectively a wage subsidy. Friedman was arguing for instead relying on a wage subsidy. And this is going to provide a strong incentive for people to enter into the labor force who had not been working previously. If you think about it, if you have an EITC, for example, or a negative income tax rate, for example, of 40%, then someone is now foregoing $1.40 for every dollar they would have earned previously. Right? To sit on the sidelines, before you were giving up $1, now you're giving up $1.40 if our negative income tax rate is 40%, if our EITC rate is 40%. So the EITC, and I'm mismatching terms here. The EITC is just a specific name for the negative income tax program when we implemented that generic idea. So those are one and the same in simple terms at least. But the EITC provides a strong incentive to get in the game, to get in the labor force if you had been sitting on the sidelines And furthermore, when Friedman advocated this idea, when people actually went to design this EITC in practice, we were really careful to make sure that we didn't have that 100% tax rate as one started to work as one increased income. So now we have a much more gradual phase out for the EITC that weakens that disincentive to work, more hours for people who had already been working. So the EITC was first proposed in 1962 with Milton Friedman. The idea caught on as people started to think more about these adverse work disincentives that may come with traditional welfare. And finally, by 1976, we as a nation implemented the EITC initially. As you see there, the EITC has grown substantially. That figure just shows you federal spending on the EITC. And you see it's grown substantially. It was fairly low through the 80s, but then starting in about 1990, it started to grow quite a bit. And now the EITC is our nation's single largest cash anti-poverty program. I mean, to a large extent, we follow the advice of Milton Friedman, even though we haven't strictly followed his advice. But it's $58 million spent on the EITC in 2013, their single largest cash anti-poverty program. This is how the EITC works. This is the structure for a single individual with one child. Here the subsidy rate is 33%. So for someone who wasn't working at all, as they start to work, now they're getting $1.33 in total for every dollar they would have earned before the EITC was introduced. The subsidy amounts 33 cents on the dollar. You're allowed to continue to collect that subsidy up to an income of $10,000 or a total credit of $3,300 or so. Then the credit amount is flat. We max out the credit at $3,300. It remains flat up until $17,000, at which point we start to phase out the EITC. But again, we have now a gradual phase out. Here the slope is 16 cents. For every dollar that you earn above $17,000 or so, $17,800, for every dollar you earn above that threshold, the government takes away 16 cents of the EITC. So you're effectively earning 84 cents on the dollar. That's a negative incentive as far as that goes, but it's much more thought out than what we see under traditional welfare with that one-for-one removal of the credit. But the EITC depends on single versus married, and it depends on how many children you have. So there's the EITC for single with one child. There's the EITC for married with one child. If you get married, we don't change the slopes. We don't change the subsidy up front. We don't change the phase-out rate, but we do allow that income threshold to increase before we reach the phase-out region. So that's how it changes for married, and this is how the EITC changes for if you have one child versus if you have two children. Yellow line is the EITC for married with one child. Blue line is EITC for married with two children. So you see that the subsidy becomes more generous as you have a second child, and the phase-out becomes a little bit more steep as well as you have a second child. The EITC doesn't go up further, though. At least I think that's right. Well, shoot, I don't know why I didn't rehearse this, but I think the phase-out, I think the EITC stops at 3 children. I don't think you get an increase for 3 children for a third child like you do for a second. If it's not there, then it's at the very least a fourth child. But just if you think about the EITC, again, it provides a strong incentive to get into the labor force for people who hadn't been working at all. You see there in the bottom left-hand corner of the figure, for people who aren't working at all, for people who have no income to begin with, we have a strong positive incentive because people are foregoing now $1.40 for every dollar they would have earned otherwise, for every dollar they would have foregone otherwise. So there's a strong incentive to get into the labor force. And that's the number one reason why people tend to advocate for the EITC. But for people who had already been working, but who didn't earn very much, who just worked a little bit, for those people who were already in the phase-in region, the work incentive there is unclear. Because there you have you have the positive wage subsidy, right? You have to forego more to sit on the sidelines or to work fewer hours, But if your goal is just simply to work to achieve a certain amount of income, you don't have to work as much to achieve that amount of income after the EITC is introduced. That's what we call a negative income effect. So we have somewhat of competing incentives in that phase-in region. As we get over to the yellow part, as we get to the phase-out region, that's where we have stronger work disincentives. Now we're starting to take away the EITC, so you're only earning 86 cents or 84 cents on the dollar. As we start to think about removing the EITC, then we also have that income effect after we introduce the EITC. You just don't have to work as many hours to achieve a given amount of income if a given amount of income is your goal. So in designing the EITC, to think about where the population lies and to think about how these different work incentives affect different groups in the population, it's important to structure those parameters correctly. It's important to structure the maximum amount, the various income thresholds, and the phase-in slope and the phase-out slope correctly, given the work incentives and given where the population lies. So there's been a lot of empirical evidence on the federal EITC over the decades. As I said, I mean, we thought a lot about the theoretical benefits of a negative income tax or an EITC before it was introduced from the 60s up through 76. But once we started to see the EITC and once we started to adjust with the EITC in federal policy, there's been a lot of work by economists to see how it really affects behavior. Right? So theoretically, economists in the classroom or in their office, we theorize that it should provide a strong incentive to work and therefore it should increase labor force participation. But the good news is over time is that it actually has been found to increase labor force participation, especially among single mothers. Some studies that I believe are pretty credible have actually found a pretty strong incentive to enter the labor force among single mothers as a result of the EITC. So increasing labor force participation, it's there theoretically and it's there empirically. That's a good thing. That's a check. That's a win. But we worry, though, as I said before, we worry about people who were already working. Could they be disincentivized to work as much? Could they be disincentivized to work as many hours now that we have an EITC, now that you don't have to work as many hours to achieve a given income over that range? There we actually have a win as well. We don't see much evidence that there's a reduction in work hours among those who were already working as a result of the EITC. Most people just work a given number of hours regardless. I mean, I have no ability to alter my work effort outside of that 40-hour range, and many people are like that. So positive effect on labor force participation, but the negative effect of discouraging more work or more hours of work doesn't seem to pan out strongly in the empirical literature. Any negative effects that we tend to find in the literature are around married couples. If you think about married couples, especially wives who have a husband who's working, those wives are going to tend more likely to be in that phase-out region of the EITC. So we see some negative effect on hours worked among married women, but that's a relatively small part of the population that we're targeting here. So there are some adverse outcomes because married women are more likely to be in that phase-out region where we're taking away the dollars, reducing the effective wage. But that's a relatively small part of the overall picture. You may find some more negative outcomes. For example, you may find people who are more inclined to just live together and not become married officially or legally as a result of the EITC. But that's probably relatively minor compared to the two positive, or the top positive benefit that I laid out. You may find other benefits as well in the literature that have been discovered. For example, there may be some improved health outcomes as a result of the greater ability to afford health care that these people face, and of course, due to the fact that they're working now, that generally improves health. So since the federal EITC has generally been regarded as a positive, right? I mean, if you think about traditional welfare with its flaws and with its lack of attention to promoting self-sustainability over time, the EITC has generally been a positive. It's generally been regarded favorably, and you saw how it grew dramatically through the 1990s in terms of how much we rely on it for our safety net nationally. So it stands to reason that the federal EITC was largely a winner. It stands to reason that states should get in on the game as well. So started in 1986, we had the first state that decided to enact an additional state earned income tax credit on top of the federal program that was there. We had a few states add the EITC in the late 80s. Then the real action was between the mid-90s to the mid-2000s. Of most of the states, as you see there, that have an EITC, most of the states added it from the mid-90s through the mid-2000s. We've had 3 states to add the EITC since the recession, since 2007. So overall, nowadays we have 26 states that have a separate additional state EITC above the federal program. Geography matters to a large extent if we think about how West Virginia is competitive, how West Virginia interacts with other states. And so there you see the geographic layout of the EITC states. So our neighbors Ohio and Virginia do have EITCs. Kentucky does not. You see it generally tends to be in place in Great Lakes states, New England states, or northeastern states. West Coast tends to not be in place in the South, with Louisiana being the exception there, I suppose. This is the EITC amount across those 26 states that have an EITC. The EITC for states is just expressed as a percentage of the federal EITC. So if you're getting $1,000 under the federal EITC, well, if the state has a 10% EITC on top of that, then you'll get an extra $100 from the state. But there you see where the amounts come in. Louisiana has the least generous state EITC. Their EITC is only 3.5%. Oklahoma and Maine come in there at 5%. The mode is 10%. Most of the largest number have a state EITC of 10%. And after Colorado there, you see starting with Wisconsin up through the District of Columbia, you see the rates range from 10% or 11% up to 40%. California has an incredibly generous EITC, but it's very narrow in scope. That 85% is only applicable to the very smallest amount of income. So there's a lot of footnotes that go along with that table. But you see generally where those state EITC subsidies lie. And really the fact of the matter is there's a pretty big range, right? I mean, from 3.5% to 40%, the states are really all over the board in terms of how much or how generous to make their additional EITCs. Some West Virginia specific figures. If you look at federal personal income tax returns that were filed in West Virginia in 2012, more than 160,000 claimed the federal EITC. That actually amounts to more than 20% of all the federal personal income tax returns filed in West Virginia. I don't have the statistics, I wish I did, but my gut tells me that's high. I wouldn't be surprised if that is at the very top in terms of the percentage of our federal returns that claim the federal EITC. We're a low-income state, so that stands to reason. There you see the total amount of the federal EITC in West Virginia, $341 million. And just a couple of back-of-the-envelope calculations. I haven't done this with any rigor. I haven't taken into account any behavioral effects. But if you just consider that the federal government is giving out $341 million in the form of the EITC, if West Virginia were to tack on an additional 10% EITC, again, in a very basic sense, that's going to come to $34 million. If it were, just a linear model here, if we decide to add a 5% EITC, that comes to $17 million that our state would be spending to provide this wage subsidy to help encourage labor force participation, to help support low-income men and women. I just made a figure here. This isn't worth very much, but this just shows you the magnitude of the numbers, right? I mean, the blue line is what I showed you before already. Single, one child, that's the amount of the EITC that you get through the federal government, going up to a maximum of $3,300 for those with an income of $10,000. The red line just shows you just how much that figure would change as a result of a 5% additional state EITC on top of the federal. I don't know why I chose 5%. I could have just as easily chose 10% or 15%. Again, you saw a wide range in terms of the generosity of the state EITCs. But that's a picture that communicates the magnitude of what we're talking about. So, I don't have good numbers. I'll just be honest with that. I mean, the research focuses on the federal EITC. Okay, all these studies that have formed into a really well-developed body of research. They focus on how the federal EITC encourages labor force participation, and they focus on how the federal EITC affects hours worked among people who are already in the labor force. So you just have to ask yourself, when we don't have good numbers to go by, but just ask yourself, how much of an additional bang for a buck are we going to get by moving from the blue line to the red line? I don't have an answer, but that's the nature of the numbers with a 5% EITC, which would come in at about 17 million. We have more special considerations for West Virginia. Again, the numbers are reflective of a national average, right? I mean, in terms of the behavioral effects that we find as a result of the EITC, they're reflective of a national average. On the one hand, West Virginia seems like it needs a state EITC sorely. Right? We have the worst rate of labor force participation in the nation. We have had the worst rate of labor force participation in the nation since the Nixon administration. I argue frequently that the fact that so few of our adult men and women are ready, willing, and able to work, I argue that that's one of our most daunting challenges. So in the basic sense, you would ask, but you would believe that if anybody needs a state EITC, it would be the state with the lowest rate of labor force participation. But then the question arises, how much of our labor force participation deficit can be overcome by a state EITC? I mean, our deficit's 10 points, by the way. We are 10 percentage points behind the nation in terms of labor force participation. National average is 63%, our average is 53%. So how much of that can a state EITC overcome? How much of that can that 5 or 10 or 15% state EITC overcome? And our deficit can be explained by, we're just getting ready to release a study a study in which we run a pretty sophisticated econometric model that we explain labor force participation rates across U.S. states for a number of years. And for West Virginia specifically, we find that we can explain about 90% of our labor force participation deficit by 3 factors: by low educational attainment in the state, by high rates of disability, by extremely high rates of disability in the state, and by transportation-based impediments in rural areas, right? I mean, in rural areas, these transportation impediments we all know about. So, personally, I think it's a tough issue. I think the EITC at the federal level has been fairly positive as far as transfer programs go. I think the evidence is strong that it does encourage labor force participation. I think West Virginia needs desperately incentives to encourage labor force participation. But me personally, without having the time to study this as fully and as in-depth as possible, I'm not for sure if we'll be able to completely overcome the challenges that we face with regards to educational attainment, with regards to health outcomes, with an additional 5 or 10 or 15% credit to make entering into the labor force that much more attractive for people who are sitting on the sidelines. And one last thing to point out is, I mentioned this before when I was down in May. We think about,
No, you're great.
Oh,
Sorry.
I gave the cue that this is my last quick statement here. I talked about the relative roles of the different levels of government when I was here in May. Famous economist Wally Oates laid out a seminal work couple decades ago, allocating the different roles of government to different levels. That is federal versus state versus local. And redistribution, anti-poverty programs. Economists generally think those are important in a general sense, but they vary widely in terms of how much we should devote to those programs and how should they be structured. There's a lot of disagreement there, but economists generally agree that anti-poverty programs should be the purview of the federal government, that states should focus more on providing local public goods and services to meet their specific tastes in their areas. But anti-poverty programs generally should be tackled by the federal government, because I mean, part of that's just practical. If this state decides to be very generous, and if the neighboring state decides not to be very generous, then you're going to have a migration flow between these two states, leading to an unsustainable situation in the relatively generous state. That's theoretical. There's a lot of other considerations when you think about migration decisions over time, but it is an important consideration when you think about fiscal federalism and what level of government should tackle what role of government.